Canadian investors are using ZSP over any other ETF for exposure to the S&P 500 index. Institutional investors, investment advisors, and DIY investors have all been trusting ZSP with their investment dollars since the fall of 2012. ETFs provide instant access to a portfolio of stocks to an investor in a single, cost-efficient trade. For an investor to own the entire index would require institutional-level trading systems and expertise. To accomplish this, an investor would have to buy 500 stocks at a time, and then as the market moves, it would constantly have to rebalance those 500 stocks several times a year. ZSP simplifies this process by aiming to provide instant access to the 500 stocks in the index in a very easy and low-cost way.
Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 139. As always, joined by the three amigos, Keith Dicker, Boomer, Ice Cap Asset Management, Rich Diaz, PGM Global. You always got to give you the plug, buddy.
You forgot.
Almost forgot your company.
Get it together here. Rich, you look like you're somewhere different today. Where are you?
I'm in London, England, where I left my heart and my bicycle. One of those.
You use a British accent, please, when you're telling us the story.
I get. Whenever I do a British accent, I sound like an Irish person, an Irish traveler. No, I'm in London. This weekend, I'm sort of in transit. I'm going on a canoe trip in the south of France. Don't ask me why.
Canoe trip?
I would fly all the way from Canada to the south of France to do a canoe trip. But no, one of my very, very dear friends sort of needed a ringer. And I'm
what the
I'm
hell
an
is a canoe trip? I've never heard of that before.
What's a ringer in the canoeing world? What is that?
What do you do on a canoe trip?
It's just actually just a piss up, man. We're gonna spend some...
you just slugging back beers in the canoe. Or
yeah.
what?
So we're going to Montpellier, which is not only sparkling water but also a small town in the south of France. And we got like an outfitter, and they're gonna drop us off at the top of a river, and we're just gonna float down river, and then we're gonna go drink some wine in a chateau, and and eat some cheese, and yeah, it's good.
Man.
It's gonna be really fun. I'm excited.
How will your
this coming out of the Loonie Hour fund?
Yes, of course. Let's have a vote on it. Anyways.
Okay, let's do the vote right now. All those with a yay, raise their hand.
No.
Yay.
Anyways,
how will your French be received in France?
My French is very good. I'll have you guys know. Because I'm an Anglophone and I speak French with a very thick Anglo accent, the French people from France, they kind of love it because they know I'm trying and making an effort, and that's all they really want. In Quebec is the same. As long as you make an effort, people. No. They're not so fond of the French Canadian accent, but that's perhaps a conversation for a different day. But the Anglo-French accent, they're okay with.
Maybe you should do the speak French, but with the British accent when you're there. You guys remember, Mike Myers, of course, Canadian community. You should hear him. He can speak French with a Scottish accent.
Oh, that's cool.
It's pretty funny. It's pretty funny.
That guy's a talent.
Yeah, he is a talent.
Yeah.
Anyway, that's it. I'm ready to go. There's lots going on. Guys,
I want to give a quick hello. One of those guys I was chatting with recently, one of my friends. His name is Gordon. He's from Alberta, the province next to Saskatchewan. But he was traveling over in Tokyo there last week, and he never misses an episode. And he literally got up in the middle of the night just to stay tuned with the Loonie Hour. So I know the week before we're talking about people in Hong Kong were following the podcast.
Yeah,
now we have Tokyo, and then we have the south of France is going to be into it as well.
I'm going to promote it wildly.
Yeah.
Gordon from Grand Prairie.
That's right. And we got Steve from Saskatchewan.
Steve, what's new? What do you have on your desk there, Steve?
Twinkie bet time. last I recall, myself and old BMO's Doug Porter there, you guys were giving him a hard time, giving him the jeers because the stock was down and he was calling for rate cuts, and we got a rate cut. So
we got the cut. So I have, I didn't have access to Twinkies.
Uh-oh.
So
okay.
I think those who know me, I'm a very good eater these days. I'm on like the no carb, kind of diet, and
He's got a
it's having-
gluten-free Twinkies.
no, I'm okay with gluten, I guess. I don't know what that is, but anyway, I'm having success. But I managed to pull this out of the cupboard. It's called a Celebration mini
Okay,
chocolate.
yeah,
That
no,
does
that
not count.
I'm gonna go on the record here. That does not count.
Well,
No,
can you hear it, Rich?
I can hear it. I can hear it not counting is what I can hear. Okay, so Keith, that's
Look how small they
Keith,
are.
you owe
Look,
us
they're
one.
little
That's
tiny ones.
This
Keith,
guy's
you owe us
eating like
one.
gluten-free vegan cookies.
That's not the point of the Twinkie. I have some bad news also. They don't sell Twinkies in the UK, and I forgot about that. So please, Loonie Hour faithful, I promise, Scout's honor, I will have a Twinkie next week, and I will eat it, and it will not be some fake celebration thing. It
Yeah,
will be
Keith,
a
you
proper
too, buddy.
Twinkie.
I'm gonna
Wow,
be
we're
bringing
really bad.
Keith. I'm gonna
Okay,
be bringing
guys.
you a box. I'm gonna be bringing you a box to Calgary for everyone listening. Boomer and I will be in Calgary next week. Boomer, I will bring you a box of Twinkies. You're gonna eat them on the next show to make up for it. We also have, for the Loonie Hour listeners in Calgary, we're going to be doing a meetup. So it's just Keith and myself. Unfortunately, Rich didn't get the invite. So Keith and I will be in town, and we're going to be hosting an event from 5 to 7 p.m. on Thursday, June 13th. So if you want to come hang out, grab a beer, have some appetizers, we're just going to chat. It's not like a speech or an event. It's just come out and have some beers and talk markets. Well, I think the Oilers are playing that night, so we'll probably have that on and watch a bit of that game. But if you want to come, there's going to be an Eventbrite link in the show notes. We're charging $15 a ticket, and the only reason why we're charging is because we're going to be covering people's drinks and food and stuff. And it gives us the ability to do a head count. So last time Keith organized an event with Rich, it was an absolute shit show. They had no idea how many people were coming to the event. Is it going to be 20 people? Is it going to be 60 people? So we've booked a space for 40 people. So there's going to be 40 tickets. And again, we're charging $15 just to cover. We're covering the booze tab. We're not making money off this. It's simply a way to get a head count. So again, those tickets will be, if you're listening to the show, the tickets are on sale. So that's all I've got for that. But without further ado, let's get into the Bank of Canada. Rate cut, Keith, seemed largely expected by markets, but
Yeah.
I don't know what your kind of takeaway was listening to the press conference.
Yeah. Well, first of all, Twinkie bet aside, it was 100% expected that the Bank of Canada would cut either at the June or July meeting. And it was a bit of a toss-up. When are they going to do it? And the momentum building up into the meeting, increasingly the market sort of said, yeah, it's definitely going to be the June meeting. And that's exactly what happened. When you listen to the presser, this is the way I heard it. I don't know how you guys heard it or it was received. It was pretty much a another victory lap. Remember, they did one about a year ago, I think, when they stopped raising rates. And now they're basically saying, hey, inflation's coming back down to the range. We want to start cutting rates again. But there was two key takeaways that I got from it. One, they were very clear that people should not expect for rates to go back to the lows that we just had a few years ago. And he was very clear with that. Because people, we tend to think in linear thoughts and trends. So, we went from 0 to 5. Now we're going to go 5 back down to 0. He said, no, that's not going to happen. He did not state what the next level will be, nor do they say, hey, we're definitely going to cut again at the next meeting. He said, no, it is data dependent. But he said, hey, we could go lower, but, don't expect rates to be back down to 2 or 3%. He didn't say a number, but it sort of implied maybe 4.25-ish, might be. We'll talk about after where they're priced coming up for the rest of the year. And then the other big thing was on the currency side. He had several questions about that. And whenever a central banker gets a question about their currency, you can always laugh because reporters know you're not supposed to ask, because the official answer, it's always going to be, hey, we're not focused on that. That's not part of our domain. And we're not, it is what it is. And usually if a currency is trending in one direction or the other, that response sort of reaffirms that, hey, it should continue going in that direction. The way it was perceived yesterday with the Bank of Canada is that when they were answering that question, it was, yeah, like we are getting weaker with the Canadian dollar and we're not going to support it. So if you want to have a go at it, go, because we're more focused on bringing rates down. So that was the two main things that I took away.
I want to chime in there quickly. This is a direct quote from Tiff on the currency. So he says, quote, "We don't have a target for the exchange rate. We have a target for inflation. We believe in flexible exchange rates." Which again, my takeaway on that was, it seems we've talked about this on the show, but basically we're going to support the domestic economy here. We're going to support over-levered households and businesses. And, the release valve is going to be the Canadian dollar. Was that, again, kind of your summarization, Keith?
Yeah, absolutely. I mean, because the challenge that the Canadians have now, and same thing with the Europeans from the ECB meeting this morning, is that, they sort of now want to start letting some more air out of the balloon, try to prevent something really bad from happening, but they don't want to go too aggressive again so that it would reignite economic growth and inflation and in that stuff. They're in a real tricky spot with this situation with it. But if the currency goes a lot lower or just trends lower, then they should be fine with that anyway. But they did, again, like from my view, and I've been looking at this stuff now for a while. If you want to draw a line in the sand as a central banker on your currency, that is your moment to do it. So they could have easily said, you know what? Yeah, we don't focus on the currency. However, we feel that the future for the Canadian economy is very positive. He could have said something like that, and Canadian dollar would just spike higher on the news. Instead, it was sort of a wishy-washy day. We're right back now to we were a couple of days ago.
Rich, do you have any comments on the BOC? I know you've been a staunch believer in no cuts.
No, I think they should raise rates. No, I don't think they should raise rates. I think you nailed it, Steve. I think that they're sacrificing the currency. And I would just remind everybody that you cannot devalue your way to prosperity. And I think that that's just keep that in mind going forward. Canada has weak productivity growth. We are saddled with debt and high debt servicing ratios, which will not be materially changed by 25 basis points of cuts or even 100 basis points of cuts, which is something I've written about recently in one of my notes for my day job. And one way that you can help alleviate some of that pain is by cutting, I would say, early. Remember, services inflation is still very high, is sticky, and a lot of that inflation that we've seen is really a function of goods. And you need to make a choice because we have poor productivity growth, because we don't have much growth at all, except for the influx of people coming to Canada. You can either have an internal devaluation, which is telling your government to spend less money, to rein in its deficits, for consumers and households to, reallocate away from to spend, to borrow less, etc. Or you can have an external devaluation, which is a currency. And we've talked about I've explained those two different options before. And so in Canada, the BOC, maybe they're not going to be explicit in their language and say this is what we're doing, but I think the proof is in the pudding, or the Twinkie, which I sadly forgot and promised to bring next week. So I think you nailed it, Steve. It was really one of your tweets that you really said it better than I could have ever done it. They really are going to sacrifice the loonie, and we will see the two things going forward is number one, how many cuts they will end up doing. So I think it'll probably end up being about 100. I think his point about not going back to COVID levels, I think that's kind of obvious and but important. And the other thing that I think is important for people to remember is this idea that it's gonna flow directly into the real estate market is a worry, but something to keep in mind is that debt service ratios, which are, our mortgage, there's mortgage debt, there's credit card debt and credit lines, and then there's an interest rate component to that stuff. They're at sort of all-time highs, and I don't think 25 basis points is going to change much of that. And so I think I think it's the sort of the worst of both worlds. He sort of acquiesced on the currency piece, and we still have a lot of pain to work through with respect to our debt.
Just on the you mentioned on the housing front about some of the potentially reigniting it there, and debt servicing ratios. I think I'm of the view that 25. I mean, you're seeing all the the realtor TikToks and Instagram reels that are out there and talking about cut baby cut, and you got to buy now. You load up on your Toronto pre-sale condos, but the reality is that 25 basis points, while it might alter sentiment a little bit, that hey, you know what, the worst is probably behind us in terms of how high mortgage rates can go, and the path is maybe a little bit more clear. I think it doesn't change the math on investors, which is really where we've seen so much activity over the last 5-10 years has been people buying second, third properties, right? It's oh, well, my house is up. I'm going to refinance that, go buy an investment condo, build more equity. It's a trade that you can't lose. And really what we've been seeing in Vancouver and in Toronto has been the surge in new listings in the condo sector, which is basically investors no longer buying properties, but actually just opting to sell, right? They're well, what's the upside if mortgage rates are going to kind of hover around these levels? I'm cash flow negative and getting worse. And so if you look at just the May data, so I'm here in Greater Vancouver, the number of new listings for condos coming to market in the month of May, it was the highest on record outside of May 2021. So May 2021 was the highest number of new listings ever, but that coincided with record home sales. So May of 2024 was the worst outside of 2021. I think in the GTA, it was the highest in, so at the end of May, the Toronto area had almost 10,000 condos available for sale, the highest number of units for sale in any month in recent history. So 25 basis points isn't going to change the math for those investors. And so I still think you're going to have issues that are going to develop in that space. So temporary relief to people from a sentiment perspective, but I don't think the math has really changed. And I don't think it's going to change with 25 or 50 basis points more of cuts this year either.
One thing, you guys reminded me of two comments to make. First of all, Rich, you were talking about internal versus external devaluations, just so people sort of really appreciate it. Back when the Europeans had their problems, and they still have their challenges, of course, not in the south of France though, but back though when their debt crisis really started accelerating in 2011 or 12, in that time. Their response, to the Italians was, hey, you need to do an internal devaluation. So
and
what happened? Yeah, and the Greeks. So what they said, hey, you got to cut your salaries and wages and things like that, because the ECB said, we ain't going to move the currency lower. We like it where it is. And so you had that taking place. In Japan today, they also have the same choice. And they're saying, hey, we're going to do an external devaluation. If you're still watching, the yen continues to drift lower and lower and lower. And as long as it's in a controlled manner, again, people are okay with that. The Chinese, they have an internal devaluation going because the currency doesn't float, right? It is basically, it is what it is. So, this is if you want to sound really smart with some nerdy people out there, and you want to geek out, talk about the internal versus external devaluations.
Was that a slight against me, by the way?
Well, I think we're all having that conversation. So we're all into cool boys, the cool kids. The other thing, I sort of want to reframe this for everyone again, because, the mainstream media, and if someone shared it with me last week, the legacy media, I don't know which one is which anymore, or the new age media, the internets and all this stuff, we become so hyper focused on this one central bank move. Here we are talking up the Canadians and the Europeans today, and stuff like that. We have to remember that you really have to step back and realize, we've over 40 years, we've gone from 20% down to 0% with rates. If you really zoom out and say, oh, wow, like this, going from 0 to 5, it seems like, hey, that was a very big and sudden move. People think things are going to get better again. The world has accumulated excessive debt over the last 40 years, and none of that is being influenced with rates coming down a quarter point at all. So we have to, again, just sort of reset things for the bigger picture here. Because even now, I think, Steve, you shared with us a few days ago, for the coming out of Ottawa now, the estimate for the 2024 deficit might be as high as 50 billion instead of the 40 they originally. Did I see that from you or from someone else? I don't remember.
No,
It's
yeah,
growing.
I sent it in the group chat there because it was yeah, I mean, Chrystia Freeland, the finance minister, said, there's the quote unquote fiscal anchor, right? Which is we're going to keep the budget deficit basically locked around 40 bill. So early projections suggest it's going to land around 50 bill. So I don't know. I mean, I don't think it should be surprising, given the.
And that's my point I'm making here now, like this 25 beep cut, it doesn't move the needle on the fiscal side of the equation. And remember, even though central banks now, they've all gone into cutting mode, it seems like, we do have the potential that, maybe we do get a bit of reprieve here, and things, there is no hard landing, or there's no recession, and things accelerate again out of the blue, because it's been very clear that on the fiscal side, so here for the Canadians, definitely for the Americans, it is spend, spend, spend. So again, this central bank monetary policy, it's still sort of up against the wall relative to the fiscal side.
So a question on that says, the often rebuttal as well, the Bank of Canada is going to sacrifice the Canadian dollar. How much does the Canadian dollar devalue, say relative to other currencies or relative to the US when, US is one of our largest trading partners. We're going to then start importing inflation, and then we're going to be coming full circle and dealing with this problem once again. Do you have a view on how much the Canadian dollar can really move before you start kind of like importing that inflation and it becomes a bigger problem?
I think there are two tracks for CAD. I mean, if the whole world stays in the same trend and, growth slows and things like that, Canadian dollar is going to stay, between 65 and 75. It'll have its moments. If we start to see a sharp acceleration in some kind of event around the world, sorry, I think CAD's going to go from, where we know, 74, 73 here this morning. It can go from 73 down to 63 very, very quickly. And then it's, central banks, they have to respond. So again, like people think, oh, it has to be this or that. It just depends on, look at the yen, right? The yen has been a consistent trend going lower without a major crisis taking place over there. If we don't have a major crisis around the world, I think it'll just, be a bit sloppy go around. If something does get out of hand, then I think the opportunity is there, to go down pretty hard. And notice I use the word opportunity, because remember, any market going in any direction, you shouldn't look at it as, oh, that's good or that's bad. Instead, say, hey, I can make money on that, or I can protect myself against that. Do you know what I mean? It doesn't have to be, buy, hold, and prosper forever. That's not the case with every market. What do you think, Rich?
Yeah, I mean, the thing about I think I just need to qualify sort of one of my comments. So people might think I'm just a heartless, like heartless hawk, let's call that, which is I just think interest rates should be high for a long time, and we should be sort of I'm immune to the fact that unemployment rate in Canada is actually rising. It's very low historically, but it's rising. And that investment is slowing, and the housing market is obviously hurting lots of people. And this idea that if you lower interest rates, it's just going to help everybody, blah, blah. But I just want to remind everybody that we've spent, I think, there's no free lunch. This is like a classic finance bro trope. And I think I think we have to, in some ways, live in a world where interest rates are real. That is to say, when you adjust for inflation, interest rates are positive for a long time in order to sort of cleanse some of this malinvestment. Sorry, Steve. And I just also want to remind people that, in the 90s, you had, interest rates at these levels right now, maybe 4 or 5. It never really hit 6, I think. It started in the 90s at 6. Anyway, my point is between 4 and 5. And core inflation was basically around 1.3, 1.4, 1.5%. And so I can't quite do the math quick enough, but let's say that's a 4% real interest rate. Again, in 2005, you had real interest rates. So the Bank of Canada's overnight lending facility rate, adjusted for core inflation, you're in the 3s. And and in between 2010 and in 2020, it was reversed. That sum was negative, and that basically drives all kinds of craziness. I think it explains why productivity is bad in Canada. I think it explains why everybody levered up instead of started to go get a real job. And then there's all kinds of social impacts that have result from that. And so, do I think that it's the central banker's job necessarily to keep that in mind? No, I think Tiff Macklem took a bit of a cop out, took the easy way out and said, we don't care about the currency. All we care about is inflation. Well, inflation is still, it's still 2.66, core inflation. Yes, it's falling. And so that, to me, I think that's one thing. The other thing I think is important to note is just quickly is sort of just another way of sort of viewing what you think the target rate should be is something called the Taylor rule formula. Now, in the US, there are some crazy congressmen from the 90s that thought that the Fed should be abolished and the interest rate should be set by basically a robot in a room somewhere that just follows the Taylor rule formula. But basically, it's meant to compute sort of the optimal rate based on the desired target inflation and actual inflation and then the output gap. And you can Google it. It's basically the neutral rate, and then it's basically half the difference for the output gap and inflation rate. And basically, what it tries to tell you is like where you should be roughly, where the target monetary policy should be roughly. And we are still way, way below what this target should be. And I think that that's really sort of an interesting little tidbit to keep in mind.
Was that the John Taylor, the economist, or John Taylor
Yes.
from Duran Duran? Which Duran? Which John Taylor is it?
It was John Taylor, the economist.
So Rich, if you want to up your game, you need to know some music stuff, right? That's the. By the way, my favorite quote from the Bank of Canada yesterday was, "You ready for it? Enjoy the moment, boys."
Oh yeah, that was funny.
Did he really say that?
He said, "Enjoy the moment." Can you believe that the head of your central bank actually says that during a presser?
It's crazy, man, because like everyone was like, I think the reporter was like, can we expect a cut as well in July? Because he's like, we just got one in June, we want another one in July. And he was like, yeah, he's like, enjoy the moment. Like, I don't know. The amount, so I will say this, like the amount of cheerleading after that rate cut, like you can tell like everyone is just levered to the guilt in Canada here, which is you had the Premier of BC, David Eby, tweeting like, "Oh, it's about time rate cuts." Doug Ford was tweeting, "Hey,
it's embarrassing."
Finally. Krista Freeland's quote, she says, "Quote: We've been working really hard to create the economic conditions which would make it possible for the Bank of Canada to lower rates, and today we see the fruit of that hard work."
Like it's Banana Republic stuff. It's shit that you read about when you're looking at economies that are run by some junta, some military junta that's been put in place by the U.S. CIA or whatever. I mean, I think it's gross that they're doing that. The Bank of Canada is supposed to be independent, and these are supposed to be real people with real jobs. They should not be commenting on what's going on in the Bank of Canada.
It should, you know, but with the Bank of Canada, it should be a bit of a somber moment, if anything. Like there shouldn't be any emotion for him to say, "Enjoy the moment. This is awesome. Yay! You know, let's party again." That
Cut, baby,
really,
cut.
yeah, that took me by surprise because you know you feel like you get to know these people, you know, over time,
Yeah.
and you know, I can just imagine the amount of stress these guys have, you know, what's happening and stuff. But, you know, that was just a little odd for them to say that. And again, again, I think they're in a very awkward position. And these people, you know, that are running monetary policy everywhere, the way it works, that, hey, this is our policy. This is what we're hired for. It isn't, you know, really a central bank. It should be if I'm the new central bank, you know, and I would make things awesome. I could run the government very easily, by the way, like very quickly. But we should do that on another episode. I have a lot of great suggestions.
Firing everybody is not running the government, Keith.
I could fix a lot of things easily. But maybe the mandate for central bank, it should be a blank sheet of paper. It shouldn't be this fixation with, you know, controlling inflation or get it to a reasonable level. So going from like hardly any inflation growth at all for almost 15 years, despite expanding your balance sheet nonstop, despite having zero rates and negative rates and using moral suasion every hour of the day, finally after 15 years, it explodes higher. And then you react to that, and inflation, it doesn't come back down, by the way. Inflation has not declined at all.
Yeah.
It's just still slowed. Like, my God, like your can of Coke still cost, I don't know. I don't buy Coca-Cola. What is it?
They're on the gluten-free, sugar-free, vegan diet.
No. Yeah. By the way, these are quite yummy. So these are the Celebration chocolate chip mini cook. By the way, I started reading ingredients now on food.
This is a paid ad.
And yeah, I'm not going to get paid for saying this, but you know, I'm always looking, okay, is there sugar, refined sugar and stuff? And the very first ingredient for this is sugar. Lord Jesus, as we'd say, enough, like it's everywhere. It's hard to avoid it. But back with the central bank guys, this isn't over, you know, as Steve mentioned, you know, there's a lot of euphoria right now. I think that's great because people have more confidence, and especially with business leaders and stuff, you know, maybe they'll start bringing some money back into the country. Has anything else happened out of Ottawa these days?
Well, we'll get to that. I mean, we've got some important things going on, but I just wanted to point out, last but not least, is Keith, you've been, I'm sure, following along on this, but you know, we always plug our good buddy Ben Rabideau's stuff on the show, but he had a good chart on Twitter just to remind everyone that historically the pain for borrowers actually starts after the first rate cut. So if you're looking at total delinquent mortgages in Canada, every time the BOC has cut historically, delinquencies tend to push higher still over the next several years. So, and I think that coincides with, you know, kind of what I mentioned at the beginning of the show, which is 25 basis points, 50 basis points, 75 basis points really doesn't change the math financially for the vast majority of borrowers in this country.
So let's just finish up here real quickly. Unless Rich wants to add something else as well, but just remind everyone, the market, this is what the markets are currently pricing in to the end of this year. So the Bank of Canada are going to do another 50 basis points of cuts. That'll be 75 for the year.
What's the just to interrupt there, what's the odds for July? Like, what's the expectations? Is it?
I have that. The WERP. So it's there's a 63% cut in July that's priced in right now.
It's kind of like, I guess people are flip-flopping between July and September essentially in the next one.
Yeah, it's the same.
Yeah, exactly.
The same situation we just had with June, July. Now it's pushed out again. But overall, the market is saying, hey, we're not going to have 75 in total, you know, for the year. That's the Canadians. Remember, it was 150. Yeah, 150 back in December. The Europeans, they cut by 25 this morning. We can talk about that for 30 seconds if you want.
I'd be curious to unpack that. I mean, was there any takeaways other than BOC moved first? Now you have the ECB today cutting by 25 bips. Anything significant out of that presser?
Yeah. The best thing about the Europeans, they always create this like economic monetary fantasy land. And so the Europeans, they managed today to do something no central bank has ever done.
Go on.
They did a hawkish cut.
Okay.
So they cut rates, but they also raised their
inflation target.
Yeah, they did. Yeah, for the next 2 years. So they're now saying we'll get inflation back under control by 2026. So it's still going to be a challenge for them over the next couple of years. But they did cut by 25 today, and the market is expecting another 50 basis points cuts. So they're right in line with the Canadians. Right,
Okay,
all the
so
central banks are in line, right? But it was weird ass stuff, right? That's what they do over there.
So
Rich.
BOC is expected to cut 75 this year. ECB is 75 as well.
Correct.
And
From a lower starting point, though. Just keep that in mind.
And now, I mean, that kind of takes us full circle to everyone's like, well, what about the Fed? I mean, the Fed has been the one central bank.
Guess what their estimate is for total cuts? Not the Fed estimate, what the market is estimating for total cuts for this year. 75 for the Canadians, 75 for the fantasy guys, their fantasy team. What is it for the Americans?
I'm gonna guess 75.
No,
it's zero.
Twinkie.
It's
zero. A Twinkie. It's 75.
It's zero.
Yeah, it's
for the rest of the year?
Yeah, 75 basis points are put in here.
75. Their markets are pricing 75 from the Fed.
Yeah, but it's a very inconsistent whether they do it or how they get there. Remember, they have the election wall coming up.
Yeah.
So and their numbers are not the probability of them cutting is not as consistent or clear as it is for the Canadians and the Europeans. But that's the only big thing that came out with
Well,
the
let's Rich, you've been kind of following along some of the US data. I know you've been, fairly hawkish on that economy as well, but it seems like we're starting to get a little bit of data out now that the US might finally be turning a bit of a corner in terms of slowing down. I don't know if you've got anything to comment on there.
Yeah, it's like, it's really the labor market that's sort of, I don't know, it's creaks and it's not a disaster. I mean, you still have decent wage growth. Unemployment rate is still very, very low. Participation rates are solid, especially for prime age working people, which is between the ages of 25 and 54 or 24 and 55, whatever it is. You can see there are job openings, which have come down, are still not multiples, but 1.4, 1.5 times the total number of unemployed people. So it's not that it's a complete disaster, but you are starting to see it fray at the edges. One of the things so unemployment, so you can see something we've talked about before is called underemployment. And it's called, there's like U3, which is the regular unemployment, and then you can Google this, so it's U6, which is called underemployment. So people who are sort of staffed in jobs below their station. Take that what you will. That's just one of the things we look at. That's starting to creep higher.
Isn't that everyone? Don't we all feel we should be working a better job?
Okay. Yes. Point taken. That is true. Take it up with Joe Powell. But the other thing that I was looking at was sort of temporary help services, which is, that makes sense. That's like the people who are the first to go. Also, the number of people working part-time versus full-time, that's starting to change. So it's just, it's what do they say? How do you go broke slowly at first, then all at once? I think we're still at the slowly at first piece in that area, but I think it's just something to pay attention to look at. But that we were talking about before we started, but nevertheless, the S&P 500 is making all-time highs. And the fact that these cuts are getting priced in means that there's still lots of liquidity. And maybe it's just not enough. Maybe it's, I don't know, Keith, I'm interested in hearing your view on this, but even though we've seen some cracks in the credit markets, which we'll get to later, and there are cracks in other types of markets like the labor market. Housing is something that's really interesting, right? Housing is a really, really important contributor to U.S. economic growth. They employ lots of people. Unlike in Canada, where we don't build enough houses, the U.S. has built a lot of multifamily units. especially in certain jurisdictions in the South, as people sort of migrate away from California's and the New Yorks to Texas and Florida. Well, we're starting to see weakness in housing construction, the labor market around there, and multifamily delinquency rates are starting to creep higher. So it's nothing terrible, but when you add up all these little crumbs, you make yourself a cracker.
Yeah, or a cookie. I was thinking the
Or a
same
cookie.
kind of. Yeah. It's I mean, you can have a couple of things happening right now. I know the Atlanta
Fed.
GDP now,
Yeah.
GDP estimate model they have. I think that's rolling over pretty quickly.
Yeah, so Keith, that plunged to 1.8% for Q2. That was down from 2.7% on May 31st and 4.1% from 2 weeks ago. So the Atlanta Fed's GDP estimate model has been plunging quite spectacularly over the last couple of weeks.
So the way the way that model works is that it's trying to come up with the exact number what GDP will be, and then as every week goes by, you get more and more data coming in. Then you get revisions to prior data. So as you get closer and closer to the end of the quarter, you have a higher probability of a more narrow range what the GDP is going to be. And this model came out, I'm guessing maybe 10 years ago or something like that, or maybe 15. Maybe 15. I was still in Bermuda, I think, when that came out. And all the Wall Street guys, they were angry when it came out. So was the New York Fed, because there's competition amongst the different Fed offices in the US. So the New York Fed, they have a permanent seat on the voting council or committee, and then all the other Fed offices like Atlanta and San Francisco and Dallas and Minnesota, they have a bit of rotation basis going on, but the New York guys, they always have a seat at the table. And out of the blue, the Atlanta Fed came out with this GDP model, and you could tell it totally surprised the New York Fed, because they were thinking, wait, first of all, this is really cool. All the Wall Street economists hated it because all of a sudden, these guys were trying to come up with the same number. The actual central bank came up with a better mousetrap to predict it, but it wasn't the New York Fed. But then a few years later, the New York Fed came out with their own model. Do you remember that one?
Mm-hmm.
Yeah,
they all
trying it out. So now you have two different Fed offices competing with each other to.
There's more. There's a St. Louis one too, by the way, just for the record.
But the Atlanta one kind of has the most, the best reputation, if I'm not mistaken.
Yeah, it is. But I mean, like Keith said, they're all fighting for it, and there's a bunch of really smart people who spend a lot of time working on it. But sorry, can I just jump in one? I know we're moving on, but one quick thing. One way I've been very hawkish, and that's because of my views on real interest rates, and maybe I sort of lay it on a little bit too thick in the Loonie hour. I think the other thing is, if you really do have the U.S. slowing and Canada is demonstrating that it is in some kind of balance sheet recession or productivity quagmire or something, then maybe I'm wrong. Maybe, cutting interest rates is a relatively sensible idea. I think it's just the real message to bring home is that unless you get like 400 basis points of cuts, which Tiff Macklem has said that's not going to happen, there's still a lot of pain to come through with respect to the debt servicing. And I think that's for me, that's the main takeaway.
The lag effect. Well, I mean, no, I think rates lagged on the way up, right? I mean, it's taken a while to kind of like filter through. I think clearly we're seeing that now in the data, and I think it's going to take quite a bit of time, right? I mean, I just look at it and say, if you get 75 basis points like the market expects this year, like it's not going to prevent delinquencies from pushing higher in 2025. I mean, to me,
that's the key that's the key message Ross sharing for everyone right now is, hey, just because the central bank cut by 25 basis points, don't think that all the financial economic struggles we've had over the last number of months and quarters, they're now all gone. Everything's been fixed. That's not the case at all. It's going to take a long time for everything to feed through here, including all the rate hikes that we just had.
Also, there's a risk, and there's also a risk that inflation reaccelerates. I mean, this is something that no one seems to be talking about. And that's just something just to keep that in mind going forward. I mean, the U.S., there's certainly a risk. Maybe it's less so in Canada because we're such a shitstorm, but there's definitely a risk that inflation reaccelerates in the U.S., right? 8% debt to deficit. as a percent of GDP. That's an inflationary number. Anyway.
Hey, Steve, has variable mortgage rates come down by 25 basis points?
Yeah, I think I believe every bank did. And just how that translates to people. So for every $100,000 that you borrow, so let's say you have a $500,000 mortgage, for every $100,000, your payment gets reduced by about $15. So
Wait, can you repeat that?
Not a huge savings there, obviously by 25 basis points.
Can you repeat that? So 100,000 gets you 15
yeah,
bucks?
for every 100,000 borrowed, approximately you see about a $15 reduction in your monthly payment.
So people probably have anywhere from $50 to $100 lower payment coming up.
Right?
Yeah,
sure. Yeah, I know if you have a $500,000 mortgage, right? It's what is that? $60.
Just think how you could use $15 of that if you live in Calgary.
You're gonna have to pay carbon taxes.
Well, I was referring to the Rager. I was referring to the Rager with Steve.
You might be able to renew your Disney Plus now.
Yeah, that's right.
Oh boy. What's next, Steve? What else you have?
Keith, you got your prediction there on the private credit space. We had a Canadian fund. So 9 Point Partners stopped paying its cash distributions on 3 private debt funds that collectively manage $2 billion in assets, and they're also skipping the current redemption window on its flagship private debt fund. So that's kind of your first big major headline that was come across the airwaves there. So
yeah, I mean, it's starting. We've been I gotta call my mom. This is something we've been talking about for a while, and it was ironic because last week, the day after we recorded last week's episode, this announcement came out. So what this means is that the industry has been getting increasingly more aggressive, encouraging investors to put their money into private credit, which is really you're investing in the bond market, but the bonds don't trade. They're issued by private companies and organizations and stuff like that. And the selling point with it is that you get a higher interest payment from it, and you make more in capital and things like that. The risk with these investments is that if all of a sudden rates go from 0 to 5 and the economy starts slowing or credit spreads widen, then potentially a lot of these companies that borrowed the money, they're issuing the bond that you just bought in the fund, they're not able to pay it back. And that will always happen. You'll always have 1 or 2 companies, will run into a problem with something. But if it happens on an aggregate level, it creates a bit of a challenge. So we've been waiting for this for a while to see if it does happen. And it just so happened, it was a Canadian-based fund manager who, by the way, they've outsourced it to other managers that are managing it. But not only did they announced, hey, we're going to stop interest payments or dividend payments coming out, but they immediately had to gate the fund. And what that means, and now where we say, hey, the fund is gated, it means they're closing the door or they're closing the gate, the fence, and you can't get out. Because maybe we talked about this last time, is that if everyone tries to redeem from a fund at the same time, and the investments in the fund are illiquid, which is what the case is for private credit as well as private equity, by default, the manager has no one to sell it to, right? They can't do it. So they were going to have a good old classic run on the fund, if they didn't do this. So they did it to save you, Steve and Rich, protect you. It's always done to protect you, right? But yeah, this was a pretty big deal. I have a lot of friends down in the US and Europe. They were texting and emailing me about it as well. So it's not just a Canadian story. It's a big movement in the credit world. And as you just said, Steve, hey, is this a standalone, isolated incident, or is it the beginning of something more? And we'll have to wait and see. I mean, our view, we've been waiting for this to happen. We've expected it to happen. And I suspect, there's no guarantee this is the way it's going to work out. But what's they say, Rich? If there's one,
there's
one
never
roach,
just one. There's never just one cockroach.
Yeah, there's never just one. There's a few of them.
So
private
maybe
equity, that's where we're going.
private equity just basically like, I mean, you hear all these like crazy stories, right? It's just like they're basically rolling up every business in America today, you know, dental practices, veterinarian clinics. I heard they're rolling up minor league baseball teams that basically just extract as much sort of value or capital they can out of the business. And then
I mean, it's
eventually,
not. I mean, private equity is not always bad, right? Private equity. There's a great company called Pret a Manger. Speaking of London,
right.
that's a private equity business. It's an exceptionally well run company. They make sandwiches, super popular. They're all over the world. Sandwiches, you know, chips and coffee. Not to give them a free plug, but that's a private equity group out of, I think it's Three Eyes out of Brazil, or maybe they sold it. But they're private equity businesses that, you know, do all kinds of weird and wonderful things that are profitable and run very, very sustainable businesses. I think Keith's referring to when you have interest rates go lower and lower and lower, you allow for more and more like wishy-washy businesses that only survive because interest rates are so low and those spreads are so tight, and they take excess leverage and they have no maneuverability, and that's the problem with, you know, these negative real interest rates. I go on and on about this, but that's why when you misprice bonds and you misprice, you know, what should be a market based rate of interest, there are knock-on effects. And after keeping interest rates way too low for way too long, when they start to rise, it's like the equivalent of the tide going out. Some people are wearing bathing suits. Some private equity companies make really good products and businesses and services and run excellent organizations. And then others aren't wearing bathing suits at all, like Keith. And so, you know, it really just depends. But I think that that's the story we're seeing. And I think there's going to be a lot of people, a lot of business, I think, that are going to be exposed as these interest rates, like Tiff Macklem said, are not going to go back down to those COVID era lows.
Yeah. Well, like basically when you have, you know, when you can't earn any money on your savings, you're forced to kind of like reach out further on the risk curve. And so
that's
private
exactly
equity is basically been nice. To your point, I mean, there's been a lot of good private equity acquisitions and businesses that have accelerated through that. But there's also just a lot of crap that people have been, you know, paying extreme multiples for these businesses and basically running them into the ground. And now that you have, you know, higher savings rates, there's a good article out from the Wall Street Journal showing that Americans earned about 3.7 trillion from interest and dividends in Q1 at a seasonally adjusted annual rate. So that's up roughly 770 billion from 4 years earlier. So basically, again, now that Americans have, you know, can get 5% in a savings account, it's not that bad just to sort of sit on your money, sit on your cash and actually earn money risk free.
It's funny, Rich, that sandwich Pret Manger, is that what?
Pret a Manger.
Okay.
They don't have any gluten-free stuff for you. Sorry, buddy.
I was in London in summer of '96. Oasis was raging back then. But I remember first hitting up that store then. I think, Rich, they used to be owned by McDonald's. And I think McDonald's
that's right.
sold it off to Three Eye guys.
That's right.
The other thing with, you know, we just talked about private credit. Now we're over to private equity. And we're discussing it publicly. So that's a bit weird, but we'll reconcile that in our heads. Thanks for giggling, Rich. That was a bad one. But the head of the Apollo Group, so that's a private equity firm based out of New York, pretty big. I bet you they're maybe top 5 in the world, maybe private equity. But their CEO, he made a comment this week as well to say, hey, he fears that there's a lot of valuations in the private equity world that they were just never marked down because of the COVID experience. And now to the point where a lot of them actually have to be marked down. So he's actually expecting losses in that space as well. Back when I was in my offshore days, we had a private equity fund. We farmed it out to Carlyle Group, the guys out of DC. And it's kind of interesting back then. You're looking at private equity. And, you know, I know what the allure is of it and stuff like that. But also, you know, if you do some research on it, you can actually create private equity returns simply by leveraging your S&P 500 exposure.
That's right.
You get the same upside. Now your downside, it's mark to market every day. So that's one of the great things with, private equity and credit is that it's not mark to market. So you don't have, margin calls and stuff like that. But, Steve earlier, you say, hey, there's no free lunch. I think it was Steve said that earlier. Did you say
I
Rich?
did it. It was me. I'm starving.
Pret a manger.
You got to go for a sandwich and do that.
No, not yet.
Yeah.
Oh, sorry. Just to correct myself, it's JAB Holdings. But anyway, the story reminds. That own
So
JAB
Jab.
Holdings owns Pret. But anyway, the story remains there are some good private equity and there's some bad. But anyway, sorry, Keith, please continue.
Yeah, but we're at the end of this cycle here now. So we're starting to see, private credit funds gated. The head of Apollo, runs a pretty big private equity side. He's sort of warning as well. Maybe he's warning for his own funds, right? You think about that. But meanwhile, 25 basis points of cuts, is that going to save the world? Maybe.
No.
Cut, baby, cut.
There's another angle. There's another angle that on this, Keith, that I think it's worth also talking about. So far, we've talked about sort of the demand for private credit and other types of credit, but there's also a supply angle. And when a company or when a private credit or a different organization wants to raise capital, they often do it they have either lockups, either 2 years or 3 years. Some of them don't have lockups at all. Some of them 25-year lockups. When corporations do sort of have corporate bond issuance, so any corporation, whatever, Nike wants to issue bonds, they do 3, 4, 5 years. In 2021, when having learned their lesson from the global financial crisis, when interest rates collapse, were pushed down anyways, when interest rates are very low, and a huge amount of corporations in the US where the corporate bond market is the deepest and the thickest and has the most breadth, they issued an incredible amount of paper. So that's the fancy word for saying corporate bonds. And they locked in this paper at really, really low interest rates for 3 or 4 years. Well, guess what's happening now? It's been 3 or 4 years. And so if you look at sort of the end, so one of the reasons that spreads have come in so spreads have come in so much is because there was a lot of demand for this credit. And the supply was really curtailed, right, as a function of sort of the knock-on effect of COVID and keeping low rates. Well, guess what? Now in 2024, you're starting to see that creep higher, but really the issuance is going to come a lot, like hard and fast in 2025 and 2026. So all those companies that have been living on these sweetheart deals in the same way, you can relate this to Canada, in the same way people bought houses and locked in their mortgage rates at really low interest rates, and now you're having renewals. Well, that's what's, there's loads of really good data on Bloomberg to show this, that credit or corporate credit issuance is going to sort of explode in the next 2 years, which, Keith, is sort of the supply piece to your demand argument around credit.
There you go.
Sorry.
Just to round that out, there's some data from Cambridge Associates shows the 10-year annualized return for U.S. private equity is around 13.2%. So, I think people look at that and say, well, 13%, and there's really no volatility, because it doesn't get marked to market, and it's a pretty compelling investment thesis there, right, Keith?
Mm-hmm. Yep, it sounds good. Did you guys want to let's swing over some of the more anecdotal interesting stories coming out of Ottawa this last few days?
Yeah.
Which one?
I don't know. I can't keep Close your eyes and pick one. Which one do you want to go with?
Can I ask you guys, have you heard about the gag order on the CBOE? No, not CBOE. The CBOE? No, the CBO is the Congressional Budget Office, which is the equivalent to Canada's Parliamentary Budget Office, where they do independent research and economic projections on different types of legislation. Is that right?
Yes, I believe so.
Well, the CBO is the Canadian, and the CBOE is the Chicago Board of Options. And
anyways, I'm not good with acronyms. You guys know this. Yeah. Everybody knows this.
But tell the story. Anyway, tell the story. What you hear?
Yeah, so they put a couple months ago they released as they would be expected to do their projections on how much it would cost the carbon tax would cost regular families, and of course this contradicted our dear leader. And our dear leader, in his infinite wisdom, has now put a publication ban effectively, and you can just, it's on Twitter. Somebody released it's a 2-page memo, effectively ban them releasing and talking about the data and how they came up with this. Sorry, I'm laughing because it's so insane. If this happened in America, it would be plastered all over the news at all times. Anyways, and so yeah, that was the story I thought that really caught my eye, especially because it relates to economic projections that hit regular people, and the fact that they basically disagreed with the findings. They're now getting involved and put a gag order.
What about
on
while we're on controversy, what about the foreign interference stuff that's been
right.
coming out there, Boomer?
It's jaw dropping, isn't it? Isn't it? I think, again, this is my understanding. I think up to 11 MPs are, if they're not under investigation, if they're not under investigation, it's been, they've been named internally. And I'm going to get this right, so at me and all that stuff and whatever. But it's I think the word to use is allege. That's the correct one. So up to 11 MPs have allegedly worked indirectly or directly with foreign countries to influence our elections and policies and stuff like that. And I think it's primarily the Chinese, I believe,
and India,
and India as well, have been implicated. So not 1 or 2, but up to 11. And it's now at the point where, the government is being, this isn't a media, it's not us making it up, but they're being asked, say, who are they? Like, who are these MPs? Like, tell us the story. And they're refusing to, of course, to list anyone or name them and things like that. But it hasn't been a great week so far for the party in
Liberals
power.
are blocking access to 1,000+ documents. And then if in today, so Mercedes Stevenson, who is was appointed to the National Security Intelligence Committee of Canada. So she was previously appointed there by Trudeau. When asked, she said, "Boo hoo, get over it." So apparently they said, well, why don't you release the names of the MPs? And she said, boo hoo, get over it. So that's not going over very well. I mean, we've got,
unless it was probably said with a professional tone and demeanor.
Just
boo hoo, get over it. Are you kidding me? Like, remember, the people in Ottawa, and I know you're listening, you work for taxpayers. You don't work for your lobby group. You definitely don't work for some foreign country. You don't work for your leader, or you work for taxpayers. That's bottom line here. And this hubris and gaslighting that takes place all the time, it's friggin' embarrassing. Just stop it. Act like an adult. Sit down. Get this stuff figured out. Because we have to, because this is spiraling now out of control.
No, but this is crazy. So I think also let's like use the language that I think that was released is like that they said people wittingly that I had to look that word up because I didn't know what it meant. It means that people like on purpose. It wasn't just like, ooh, I left a briefcase at a house party by accident. It was they were actively helping foreign governments and working in the interest of those other governments repeatedly on purpose over a long period of time. I don't know like how else to say it. And it's, even CBC ran the story. So it tells you how serious this must be.
Yes, Rich, they were also accepting knowingly or through willful blindness funds or benefits from foreign missions or their proxies, which have been layered or otherwise disguised to conceal their source.
So wait a second here. So the commies are working with the commies? Is that what's happening?
No, but that's the point though, Keith. You nailed it. I don't care who is it, left wing, right wing, conservative, NDP. I'm sure it wasn't the Green Party, who they have no influence. But I mean, and like if you're a proud Canadian, which I am, we should be screaming for this. It doesn't matter who it is, even if they're on your side, they should be out tomorrow. Basta. And I mean that should be the discussion. Even if They agree with your political views. It doesn't matter. They've absolutely, with prejudice, have demonstrated that they should not be trusted in the annals of power in this country. It's really that straightforward.
Give us the names.
Boo hoo, boo hoo. What a bunch of
us the
wackos.
names.
Come on.
We'll announce the names of the next live Loonie Hour event.
That would be so funny. Well, also, here's another thing. I think the irony is like, I mean, Canadians are, I think, way too docile about the fact that we're run by a bunch of idiots. But also in a weird, perverse way, I think if they had just released the names, I want to think that like everybody would have just forgotten about it in the next news cycle. I don't know. Maybe I'm too cynical, but the fact that they like haven't released the names, I think it makes every journalist with any kind of shred of integrity left in this country desperate to find out the names. And I think they're going to get leaked eventually. That'd be my hope.
Okay. The best part about this is our boy Sam Cooper.
Oh yeah, of course.
Podcast.
Friend of the show.
Yeah, friend of the show. I think he's been really leading the charge on all of this, stirring the pot and uncovering tidbits. And yeah, he's doing great work. So we need a lot more journalists with integrity, such as himself. Old school journalism. Sam Cooper.
Speaking of integrity, and anything else come out of Ottawa this week? Anyone condescendingly telling us not to wear plastic stuff? And
no, we'll leave it there. No other scandals other than it was good to see Tiff Macklem and your girl there, Carolyn Rogers, wearing Edmonton Oilers pins during their
I saw
announcement.
That.
Did you see that, Rich?
That's okay. I'm okay with that.
I love it.
I'm okay with that.
It
should be a Montreal Canadian. To be clear, it should be a Montreal Canadiens pin, obviously. But I'm okay with the Edmonton Oilers thing.
Why should it be a Montreal Canadiens pin?
Because we're the best team. We have the most Stanley Cups. We're Canada's team.
Those cups have a large.
That's why Rich is not coming to Calgary. I mean, the Oilers are in the finals. That's why they're wearing Edmonton Oilers pins in support.
Battle of Alberta. I am curious to see how many Oilers fans there are in Calgary.
There must be a bunch.
That seems like a faux pas.
You think? We'll have to find out. You guys will have to report back.
Keith, maybe you should wear an Oilers jersey to the meetup, see if you get beat up.
I sure hope not.
It's a good place to leave it. Like as we mentioned, there'll be tickets to the meetup. Hope to meet a bunch of you guys. We'll probably do like a more formal, bigger live Loonie Hour event. It's just a lot of work and coordination. So hopefully we'll do something later this year. But we're trying to do a little bit more of these kind of meetups when we're together spontaneously. And like I said, we hope to see a bunch of you guys there next Thursday, June 13th. And as always, we appreciate the support of the show. And we'll see you next week.